right now and just going to refresh it. Kunal, there's not much of a material move in IT as was anticipated, but do you think that there could be a chance that perhaps some of the mid-cap IT names could spring up in action, although the Nifty IT index at large is down 0.5%?
I would believe that possibly these large cap IT stocks are the ones which has to move up first. So Infosys, TCS, they're the ones which have to first initially show signs of strength, or at least the stopping of falling for these names, and then I believe that the confidence would trickle into the mid cap IT stocks. So I don't believe that it could be the other way around. Infosys and TCS, they're still showing some signs of weakness on the short term charts, even though it's not been added to a major damage to the Nifty IT index. But I believe that's how largely the trend should shape up.
Okay. Nuresh, let's look at mid-tier banks. That's where the action has been the highest. If the bank nifty gets jammed, do you think the small mid-tier banks would be the first one to fall?
My view is we've started a structural trend on the banking space. So would be actually waiting out for dips in the banking space, say something like a Canara Bank or a Bank of Baroda. If they take a 5-7% dip, that is where I would like to go and participate rather than trying to play the 5% downfall. So overall, extremely bullish with a medium-term view on all the banking spaces. So I would not try to play the 5% downtick, rather wait for a 5%, 7% downtick to actually go long in some of these names.
By the way, today is National Cinema Day also. All cinemas are going to have tickets slashed to 75 rupees only. Although already my colleagues tell me that recliners are still expensive. They're not 75, but 200 rupees. But still, 275 is actually nothing as compared to how much we're used to paying for movies. Nowadays, PVR though has started off a little bit tempered in trade, and Inox of course being the other one as well. Actually, cinema as a space is really opening up, right? Nikuj, I don't know if you know, but Ajay Devgan is now moving from regional multiplexes and getting into this business whole hog, as I understand.
Is it, as in he's moving into regional multiplexes?
Yes.
You know, Aisha, we always think...
And international as well.
You know, if you talk to Ajay Bijli, I mean, you've spoken to him a lot of times. And when I spoke to him last when the merger of Inox happened, and I said, look, I mean, now there is domination of multiplexes. No. There are still single stream movies which in a sense will have a very large role to play. And the more you think about it, regional movies essentially will be more like a small town phenomenon or a tier 2 phenomenon. They are crucial, they are important, and that's where I guess rather than English or Hindi, regional movies will actually do well. You may be a small and a niche player, but you may be a highly profitable player even with a single screen, or maybe, you know, with some theaters which in a sense are single screen. But 75 rupees and you can enjoy any movie today as long as it's not in recliner. It's actually not a bad deal. Trust me, it's not a bad deal. So one of those days where Aman Chowhan is also ready, but I've been told he was late because he was trying to book tickets. Being a value investor, whenever things are cheap, Aman will like to track the garment. It's okay, Aman, if you're joining late. Picture ka ticket mila?
Still trying. I'm looking for the credit card deal also along with that.
Yes, that's why we call you a value investor. Always look for bargains. But you'll have to still pay for popcorn and Pepsi, Aman.
Yeah, that's the business model that evolved now.
So where are bargains in the market? Where are you shopping?
Last when we interacted, I was mentioning about mid-sized private banks. That is where we have done some of our shopping. Microfinance as a segment is looking interesting. So we have added some exposure in that space. And overall, there has been a general trend in the last few months. If you see, people have moved away out of IT and pharma and got into anything and everything which is linked to domestic manufacturing and domestic demand. It is defense, it is cap goods. So these spaces, we have not yet looked into defense because of the PSU nature where we are not very comfortable. But this segment is good. EPC, which is also an indirect beneficiary of whatever demand people are positive on, that space is also looking pretty interesting to us.
Aman, I'm just going to draw your attention to not global inflation or Fed, just to the local money market cues. Rupee at 81 and bond yield at 7.31. Now, money market in India is feeling the heat of global macro, but equity markets are not panicking. Is that is that good, or that is ignorance by equity markets?
I'm told that the current deficit in liquidity locally is also due to the GST payments and some one-off payments, and liquidity is not as bad as what is turned out to be. So it's more of a near-term phenomenon. Uh, Yields are rising. It was expected. There is nothing majorly worrying in there. I believe maybe another 20, 30 pips further raise can happen, but that's not something which is going to move the needle in India. See, in US, what happens? Your mortgage was 2%, which has become 4 to 5%, and hence your EMI payout is 2x of what it used to be. In India, it was always 6, 7%, which is going to 8%. The 1% here and there is not going to have a meaningful impact on demand or your decision making. So from that perspective, I'm not too worried as far as the interest rates are concerned for India.
I mean, I can see that some of your large banking exposures are ICICI Bank, SBI, and there is, of course, Federal Bank as well. Do you worry at all about this transition or, shift which is happening within the banking pack, wherein names like IndusInd Bank, for instance, are, spiking up way more than ICICI Bank and the likes?
It's more of a catch-up by IndusInd Bank versus ICICI Bank. From a business perspective, from the size that ICICI Bank is, the growth rates are not lower than what IndusInd is. The NPA ratios, any other metrics that you see, ICICI Bank is much better placed than IndusInd Bank. The recent performance in IndusInd is more of a catch-up than anything else. So I'm not pretty worried about that.
Aman, there is a strong debate on IT, and I just want you to just hear the data out. And what we'll do is that for the benefit of our viewers, we'll put the graph of the IT index for the year and the bank nifty, and then we'll stretch it up to the COVID low. Now, in this year, the bank nifty is up 14%, IT index is down 30%, big divergence. But if I go all the way back to COVID, from the COVID low, the bank nifty is still underperforming the IT index. And this, I'm talking about a sector which got re-rated because of COVID, which is the IT index. So can we put two and two together and say that, look, the bank nifty, even though it has done well this year, it still has a long way to go on the up. And the IT index, which has done badly this year, but if I look at the COVID low, it still has a long way before it bottoms out.
Life is not that simple. But yeah, one hypothesis I completely get with you, that banking index has still a long way to go. See, what happened was the 10 months of FI selling, the first level of that FI selling was predominant in banking, because that's where the maximum exposure is. These are liquid names, and that's where FIs have bulk of the money. And hence, banking was the worst performing sector. This then followed by IT, because IT is the second largest exposure. And this also coincided with the view that the globally demand is slowing down, and IT has the maximum, you can say, global exposure within Indian companies. So banking, yes, there's still some steam left. Outlook is good, not just some for a few months, maybe for the next 2 to 3 years. I feel banking can outperform. As far as IT is concerned, I don't think they'll go back to COVID lows, because one thing has changed meaningfully. During this COVID lows, Indian IT offshoring model has got global recognition. There was not a single day when banks were down. There was not a single day when servers were not working for any of the major corporates. And everything was work from home, and still they were able to handle it. So now this is a very clear case that IT demand for Indian companies is going to stay. The kind of spending that we are seeing for cloud, the kind of spending that we are seeing for networking, every company who was into legacy systems now wants to upgrade. They want to be enabled to work from home. They want to network their offices. They want to network the global systems. But that spend is here to stay. And for the next 2 to 3 years, this is a clear thing that the demand is going to stay. But people right now, or investors right now, are worried as a near-term trend where margins are recovering back to the low, to the means, because travel cost is back. People have come back to office, so the tea, coffee, and AC bills and everything is back. So that margin pressure is there. And there's also attrition. At 25-30% attrition is definitely going to bite you, because salaries are up across the board. But I feel the Indian IT companies will be able to handle it. In the next 3 to 6 months, the dust should settle as to whether there is a hard landing or soft landing in US. Post that, I feel IT should do well. So I don't think IT is going back to the pre-COVID levels. It should stabilize somewhere here, or maybe 5-10% lower. So that's broadly what my view would be for banking as well as for IT.
Aman, given that one of your top holdings does include a Radico Khaitan, I'm quite tempted to ask, what is it that you're making of the entire liquor space? And, I would just sort of extend it to the large overall consumption space and tie it in with the upcoming festive season. We're all seeing what's happening with some of these textile retail plays. Trent, of course, is in a different orbit altogether, but catching up with it are the likes of Aditya Birla Fashions, Go Fashions, Vedant, what have you. The entire space is buzzing. And yeah, needless to say, liquor companies continue to do well.
So whatever monthly trends that we follow for this sector, the demand is holding up. Radico specifically is a play more on premiumization. That segment is something which is the mid-premium segment. I'm not talking about the super premium where the MNCs are pretty dominant, but they are vacating the mid-premium segment, and that is the space where Radico is filling up, and that's where the investment story for us is. So this space, obviously, margins are better, and that ultimately reflects into your profitability and your return ratio. So, uh, besides Radico, there are not any other pan-India player who can fill up this space. So it's an open ground for them, and that's what the excitement is because the competition is still very local. So whatever space the MNCs are vacating, Radico is the only one to benefit out of that.
Okay. Aman, at what point in time IT will become what could be called as a value buy? And I'm talking about just the large cap IT stocks here. I mean, the Accenture number don't inspire too much of confidence in someone. So now market will be in a process of really rediscovering the right value zone for them.
So these are the companies which will have a 15 to 20% growth rate. Maybe the big companies will be around 10 to 15%. So anything between 15 to 20p forward is where I believe the value zone will come in. Some of these companies are near that, HCL Tech and maybe Wipro, but they have their own concern, and that's the reason they trade at a discount to Infy and TCS, but they are already in this zone. Maybe another 10-15% lower for Infy and TCS, and then they get into the value zone because these companies are not going to trade at 10p. They're generating free cash, great management, global businesses, and you mentioned about currency, it is close to 81 and headed towards 2 to 3% annual depreciation. So that benefit will also come in. So these companies are global companies, and anything below 20, and it would be in my investment radar.
Okay. I'm just going to switch gears here and mark the market. And for a minute, if I look at the market breadth in a sense is not bad at all. Given where global markets are versus where we are right now, I think we've done rather well for ourselves. I mean, we should be very happy of the fact that the outperformance in India, not only it's real, I think is here to stay. Look at the advance versus decline ratio. It is not like horrible or markets are getting completely chopped off. Aman, so I mean, I remember you and me did not agree in terms of the investment thesis for mid-cap stocks, mid-cap banks. I mean, my view was that big banks would gain, and your view was that these stocks were too cheap to be ignored. Has that adjustment got over?
It's ongoing. Last 2 months, mid-sized banks have done better than the large banks, and I feel this trend can continue for another at least 3-6 months, if not more. See, whatever is trading below book, and if the growth outlook is there and there is a clear visibility that the ROEs of these mid-sized banks will cross double digit or go near 12 to 15%, and there is no reason why these banks should trade below book. So even if you're trading at 0.7 going to one-time book is a good 35% return. That 30% return on a point-to-point basis would still be higher than what an ICICI Bank and HDFC Bank would go, which would be anywhere, say, in high teens. So purely from a price performance perspective, still there is steam left for mid-sized banks.
Aman, interest rates, they act like gravity. If interest rates are likely to move higher, that will impact valuations. That's what we've learned in basic finance valuation models, right? But what amazes me is that if I look at the good, expensive high P stocks, MRF, Trend, Vedant, like Aisha asked you, these stocks are refusing to come down. So why is that happening? My point is that here you have a template which tells you that you should avoid these stocks. But if I look at the price action in a Trend, DMart, Vedant Fashion, they're just going, they're doing cartwheels, right? I mean, cartwheels is the right word.
So I think it's more of a function of scarcity premium. There are very few businesses in India which generate good cash flows with good ROCs, and there is a long queue of buyers wanting to get into them. And that is one of the big factors why these stocks just refuse to come down. If there's a seller for some reason, there are enough buyers to look into these names. So uh, and these companies continue to do well. If there's a long period of underperformance where they don't deliver on earnings, then the stock languishes. We are seeing a long period of time when Lever didn't perform or Bata didn't perform. So it's also a function. Right now, there's a good earnings visibility for these stocks, and whenever we have seen, whenever that's the case, these stocks do tend to overshoot the normal PE band that we say. So because markets are never rational, both on the up and the down. So uh, it's more to do with that. Decent earnings growth, and people are okay to pay premium. These are performing names, so nobody wants to stay away from that.
On the show, thank you so much for taking the time and speaking with us today.